jam because we're live. What's up, everybody? Welcome back to another week. This is the Good Life Visual Audio Podcast. As always, I got Kobi here in the building. Say what's up.
Was live.
We needed the
Oh man, it's good to be here. I had to move a mountain and drain the sea to get here. We got to celebrate. And man, listen, I don't know about you, but I'm excited to talk some insurance today.
I don't, I don't think anyone in the history of anything has said that. Like, yeah, I'm looking forward to talking about insurance today. But in fact, that's what we are doing. Because again, this is the podcast where we're talking how to design your life with extraordinary health, extraordinary wealth, and all the other components of mindset that come into it. And today we do have another good one. We got another one. I wish I would have known the episode of the last life insurance talk, but it was probably 50, 60, probably episode 30 something,
It was a couple of
35
decades
ish.
ago.
Yeah, it was like episode 35 ish, 36 ish. I don't know. Hembo, you could put it up.
There you go.
But we got a chance to talk about life insurance, and now we are back specifically for today's episode because September happens to be Life Insurance Awareness Month. So at the time of recording this, it is September, and we are in the midst of this month where we are making people aware of life insurance. So that's the conversation today. It's not always the fun topic, but I'm gonna hopefully shed some light on some things because I think it's just worth having the conversation. We all know that, or maybe we don't all know. Let me start by posing the question, Kabi. When did you hear about life insurance? How did you kind of think about it? Did you know it was a necessity? Did somebody have to tell you you should have this? What was your first encounters with life insurance?
My first encounter of life insurance was to true crime novels, where not novels or shows like Dateline, or people were being murdered for life insurance, and I was like,
Hmm.
God damn, I don't know if I want life insurance in my relationship. This seems this seems tragic. So that was my first exposure to it. Obviously, not the very positive one, but then later on, after college, when I was trying to get my financial life in order, realized that the honeymoon phase of life, 4 years where you can just count on the government to give you money you didn't earn, to go to school you probably aren't going to use, and now I had to get my stuff in order. That's when I started to hear about life insurance. And man, listen, quite frankly, the first person I learned it from was you know who
Uncle Dave, huh?
Uncle Dave. Yep. That book, Total Money Makeover, man, changed my life, and it was the first one that was actually laid it out. That was like, hey, you should get life insurance if X, Y, Z. I was like, oh, okay, so this is not just for spouses who are trying to, out their partners to get all this money. It's actually relevant to everybody. So that was my long about way of coming about life insurance. And yeah, man, now we're
Listen,
here.
that is a way that a lot of people actually do hear about it. In all honesty, it is some form of negative fashion. So and so tried to kill their spouse for the life insurance money. So and so tried to kill their grandparent for the life insurance money. It's definitely a story, a side of the story that's out there, right? And hopefully people don't take it as that being the only reason someone would have it. But again, how we get introduced to it is important. We talk a lot about on the show about awareness and just, being aware of certain things. Sometimes you don't know what you don't know. And sometimes you get introduced to things and you don't know what their proper benefit is for, what the proper usage of it is for. You just hear it from someone or, to kind of take the information as it comes. So that's what, I want to clear up a little bit of that stuff today. Not going to dive into too much because again, I want you to go back to that episode. Again, Hembo, put it up here on the screen, whatever that episode is. because that's where I really broke down. I remember we really broke down all the differences and the different types of insurance and why you would use it and all the details of it. So you can go back and listen to that one. But for today's show, I really just kind of want to talk about some of the more, I don't want to say controversial necessarily, but more of
Oh,
the, yeah, more of the topics that have people split. Right. More they have people split out there. There's in the insurance world, there's a lot of times people that fall on one side or the other. And we're going to talk about your Uncle Dave for a little bit, right? We'll talk about your Uncle Dave and which side he sits on, right? And why he might sit on that side. But in general, just for everyone that's listening right now, again, I want you to take something from this episode specifically in the month of September, because life insurance is the foundation to a family or to an individual's financial plan. Life insurance, just really quick, I'll throw this out there. We have to reframe it. This is something I've been helping a lot of people reframe. You have to reframe it. It's not always about burial, it's not about death, it is about income replacement. That is one of the primary usages for life insurance is income replacement. So, if you are making an income for either yourself or your household, your income is required to run that household or to do the things you want to do in life. And having life insurance is going to give you the ability to protect that income. And in the event you are not here or the breadwinner is not here, that insurance company is now going to be able to pay to make sure that the monies that someone was going to bring in stays in the family. So it's literally income protection or income replacement. I've given this example to some people that have young children before they get insurance, and I say, hey, listen, if you make $50,000 a year and you do that for 20 years of your life, you're going to make $1 million. So it's likely that everyone, most people, will make $1 million in their lifetime. Because if you just, I mean, from 18 to 38, if you worked for
is that
those,
before or after Uncle Sam takes his cut?
well, well, before he takes his cut, right? Gross income. Everyone will gross $1 million, right? Meaning of earned income, like things that you've earned, but you won't see that $1 million normally. You won't take it all home, but most people will actually bring in that amount of money. So, God forbid you were to transition or you were to pass away earlier than expected. Yes, family is out of a loved one. That's the hard part, right? We're out of a husband or a wife or a daughter or a son or a mother or a father, like whatever. We're out of a loved one. That part is important to mourn and grieve. But the other thing you're out of is you're out of their income and their income earning potential, right? Their income and their income earning potential. And those things are what needs to be protected to make sure those things continue to stay in the family. So people should have 5 to 10 times their annual income in life insurance protection. It's just a good ballpark. So make 100 grand a year, you should have anywhere between 500,000 to $1 million, just in case you pass away and 5 to 10 years worth of your income is being left behind to your family so they can figure out what to do now that you're no longer here. That is one of the primary reasons that we need life insurance. And it's really just for income protection or income replacement. Is that a way that you've heard about it before, Kobi?
Yes. Yep. When I properly researched it, that's how it was presented: income replacement. So yeah, the way I heard it was not you. That's you need that insurance if for the breadwinner in the family, like you described, because obviously that would be a huge hit, and it makes sense. I don't know if you're going to go into this, bro, but another way I've heard about it, particularly described, I forget who exactly, but maybe people like Earn Your Leisure, who have described it as like kind of like a generational come up, right?
Hmm.
So if that makes sense, so people, and particularly in our communities, getting life insurance on the elders, and that being not just for the burial, but also a way to level up the entire family situation when that elder passes. It'd be more so yes, income replacement, but also more of like a strategic kind of once in a lifetime, literally like boost for the
Sure.
family. I
Yeah.
don't know if we're gonna go into that at all.
I wasn't, but I'm glad that you brought it up because I've heard strategies like that come out. And again, that's what we're doing on this show is just kind of talking about some of these strategies that you might have heard of. And that's definitely a strategy. The way that they talk about it is, like you said, kind of this like once in a like one opportunity to kind of boost our family's financial position. Let's say in this scenario, you know, grandpop is 80 years old or whatever the case is, and right doesn't have as much coverage, but he's got 6 kids and all the kids pitch in and they all put in $200 a month or $400 a month, and then they go off and buy grandpop a huge life insurance policy, uh, and knowing that eventually he's closer to passing away, right, that money is going to pay out and it's going to pay the family, and they're going to get a return on that money basically by having more monies passed down. Now, that's a strategy that you hear. Here's oftentimes why that strategy doesn't work, is because life insurance only deals with your age and your health. So the younger you are and the healthier you are, the less you pay. The older you get, the more unhealthy you get, the more you're going to pay. For people that are older, 70 plus, there's a lot more limited options when it comes to life insurance, right? Companies know, these insurance companies are very smart. By the way, insurance companies are the most solvent companies, right, in the world. Like they back the banks, so they're really vetting. Like they obviously have enough money, but they're vetting that, like, okay, is this person high risk, not high risk? Because we don't really want to have to pay all this money out that quickly. We want our premium so we can reinvest the money, yada yada. That's how they make it. So they're really trying to figure out, hey, this person's 72 years old. They're not going to have a lot of options for life insurance policies. Not to mention, what is grandpop's net worth? These are the types of questions that are on insurance applications. What's his net worth, and or what's his annual income? So if grandpa doesn't have a high net worth and only owns like a house, and then really is retired and not really making a bunch of money, to be truthful on that application, they might not allow grandpop to get a lot of coverage because he's old. They He doesn't already make money. He doesn't have a lot of assets to protect. So they're trying to figure out, like, well, why would we get him this $1 million of life insurance at age 70, which is going to run him $4,000 a month, even if he could pay it? Why would we do that? So that's why sometimes that strategy that you hear, that I've heard before too, it doesn't actually play out that way. It doesn't always work that way. Really, it is the right strategy, but not on the back end, not where it's like, oh man, we're kind of late. Let's go pitch in so we can make this move really quick. But this is how we should all be thinking long term. You should try to have the largest life insurance policies so that you can pass down more and more monies. At the end of the day, the higher that your net worth, the different reasons why you would use life insurance. One of the key features of passing down life insurance, if we're going to talk generational, is that it's the only way to pass down the tax-free money. Right? Everything else will naturally get taxed by the estate, just on transferring, right? Whether they be accounts or assets, they will be taxed. Life insurance is a tax-free benefit. So if someone has a $7 million life insurance policy, meaning their death benefit is $7 million, their beneficiary is getting a $7 million check. No taxes. No taxes need to be paid on that. No taxes come out of that. It is the only way to actually keep passing down that tax-free money on that side. So that's one of the benefits to having it, is making sure that you can actually get it to the people that need it. Or if you're higher net worth, making sure that you are paying off estate taxes and those types of things that come with the transferring of some forms of wealth.
So you're saying two things. First, um, to your point about how diligent these companies are about vetting their investments, essentially, right?
Mm-hmm.
It's really interesting to me. I have a friend who's probably one of the most brilliant mathematicians I know, and I worked with him at when I was a teacher. He was doing his PhD in like mind numbing mathematics. All right, so and he now works for insurance companies. He's an actuary.
Actuary.
Yes, yes, yes. So he goes in and he just dances with numbers and all this stuff and to put and they pay him a hefty sum to make sure that they make even heftier sums. So that's really interesting.
That's right.
To your point there. And then at the other point, you said it's the only tax-free transfer or one of the only tax-free transfer. Can you expand on that?
Yeah. So it from a product standpoint, that life insurance benefit is going to transfer to the next, right, the beneficiary, completely tax free, outside of having business entities that transfer or trusts that transfer down. From a product standpoint, that's the only product that's going to pass to the next of kin tax free. Right.
Compared to what other products?
Right. Any other savings and any other vehicle that would transfer uh like cash, like actual like money down, right? So like people
Real
that have,
estate, cash, stocks, bonds, things. Are those the type of things?
correct,
Okay.
correct, right? And
Metals.
yeah, because all of that's owned by the estate, and so the estate will be taxed,
Okay.
right, upon somebody transferring to the next of kin and like passing down, right? If family owns properties and coins and metals and all that type of stuff, on the transferring of the estate, on passing down the estate, there's going to be estate taxes on it.
Got it.
So
Got it.
anything that's inside of there is subject to that, right? It's all
Yeah.
formulated in there.
And is that a state tax? Is that with the state, federal, both, municipality? Uh, how many times? How many people are dipping their hands in there? And who's?
That's a good question. I'm not an expert on this one. We might need an estate planning attorney and or a CPA.
Let's do it.
But that's probably, there's going to be multiple hands in there. It's going to be the federal tax, your state, or like your whatever the local jurisdiction is. All of them have their hands in the estate tax side of things. But to get like specifics, we probably got to get an estate planning attorney, or
Hembo, let's make
even a
sure we mark that down. Let's get a CPA, an estate. What was it? An estate attorney.
estate attorney.
A state
Yeah,
attorney.
yeah.
Let's go ahead and get all of those people plus Dr. Seuss. Uh, but let's get some of those folks on there so we can ask, because as we get going here, I know I'm asking all types of research based questions that I'm sure people would love to know. So we'll definitely get that in there at some point.
Absolutely. And that's the type of stuff that's important to know, because we only normally go through that process once or twice in our lifetime, right? Like we
Yeah.
might not see that happen too often unless you're in the industry or whatever the case is.
Right.
So you're not going to have all the information. You're not going to kind of know it unless you get the education or somebody that you're close to gives you the
Yeah.
education around it.
Yeah. So very critical, very critical. Along that lines as well, before we get back to insurance and dive a little bit deeper along those same lines, Emma, we should definitely get a probate attorney on
Mm-hmm.
here as well. That's something that a lot of people face more than we like to talk about. That they have no idea what to do until the time comes, and then I was pretty deep into that world on the real estate side.
Mm-hmm.
So it'll be one that I would love to dive into, because it will face somebody who's going to see this. The chances are it will face them. If Steve Jobs a state can go through probate. Ours or somebody here will probably probably
Absolutely.
face that at some point in time. But getting back to insurance, there was
No,
I
that
have my
that
questions, but I would love to see where else you want to take it.
no, I was just gonna say that side, just what you said about the probate side is really important too on an estate planning side of things, because people don't know that, right? Basically, your stuff gets seized, and you have to go get it back from the government, right? Like, it's not just yours free and clear. Like, we don't just own this stuff. You actually have to go get it back, and that's where having a will, having a trust, specifically having a trust, will help you avoid some of those types of things. But all of it's education, ladies and gentlemen. All of it's education. So that was
Say
my two
well,
cents.
yeah, yeah, absolutely, absolutely.
So, what specific question did you have? I had a couple other ways to go, but let's just take a couple of your specific questions. Could be. I was going to get into the number one, which was cash value life insurance versus term, because that's, I know your uncle Dave. We have that conversation. But tell me where else, what other questions you have that are pressing?
Well, let's deal with some of the fundamentals. I mean, we talked about it being replacing income,
Hmm.
but some of the questions around it, such as at what point one should pursue it. If there's only two individuals in the household, should they pursue it then, or should they pursue it when children are involved?
Yeah,
Should how much should they be looking to get?
good
Where do
question.
they go? Where should we be going? What's maybe what does the process look like?
Hmm.
Right. I know when I first looked into it, what I heard versus what I hear now, it seems very different as to it seems like the process has changed. That
Hmm.
may or may not be true. Yeah, I'll maybe covering some of
Yeah.
those fundamentals before we get into the controversial.
Yeah, that's dope. I'll actually cover all of those because that's a pretty basic information that I think people could benefit from. So let's take the standard couple that doesn't have children yet and is just married, and they're in their late 20s or whatever the case is, early 30s. And the question comes up of like, should we look at life insurance? So I'm not saying this as being biased, but absolutely, the earlier you look at life insurance, the better, specifically because life insurance only deals with your age and your health, like I said. And the younger you are, the less you're going to pay. Okay. So we always want to give ourselves the chance to have the best possible life insurance product, meaning getting the most coverage for the least amount, or right, being able to get approved for the policy that fits us the best. And when we're younger, we're typically better able to be insured. As we get older, and as ailments come, or as medical things happen, we are less and less likely to get approved at higher ratings for the insurance company. So that plays into the hands of the insurance company. If you waited until you're 45, you still might be healthy, but you're not as healthy as you were when you were 25. And uh you might have had a surgery or two somewhere in your late 30s, early 40s. All that stuff then starts to pop up, and it becomes how you get rated for life insurance. So typically when it comes to getting a life insurance application filled out, they're going to want to know things like your driving record to see exactly how much of a liability you are, how much of a risk you are, right? Do you have a bunch of DUIs? Do you have a bunch of points on your license? How safe are you on the road? That's one of the things that comes in. They also just want to know your basic medical history. Now, this might be one of those things that you said has changed. Um, Before, they used to have a nurse come out to your house, and or you could go to a place and get your medical done, like go to a doctor or something like that. But normally they would have a nurse come out to your house. They take a couple vials of blood, do a urine sample, do some height and weight, ask you some medical questions. They're there for maybe like 20 minutes. And then all of that information, they send it back to the insurance company. It meets up with the underwriter who works with the actuary, right? The actuary, by the way, is just somebody that studies um, the probability of you passing away. That's really it, right? The life expectancy, the probability of you passing away according to blood work, according to family history, all that type of stuff. So that's what they're looking at. They're looking at probability. But you go through that insurance application, they're checking for the driving record, they're checking for your medical history, because they're not sending a nurse out now. So they're just going to pull medical records and medical information. And they're going to approve you, right? They're going to see if you answer all the questions properly, or right, if there's any red flags, and then they're going to approve you with a life insurance policy. And you're going to pay that life insurance policy just like you pay car insurance or any other form of insurance that you have. You could pay it monthly, you could pay it semi-annually, you could pay it annually, and you'll have that coverage depending on the type of policy you have. You'll have that coverage as long as you pay the policy. So,
oh, it's unlimited. You'll
say that
have that
again.
as long as you pay for. So for I thought it
for
was
for certain types of policies, right? Like, so for technically, if you want to be technical, and this is where I was going to go in, you have term life insurance and then you have permanent life insurance. So those are the two different types of coverage out there. Term, it's temporary. So typically you're going to get a 10-year, 20-year, or 30-year term policy. So that means if you're 40 years old and you get a 30-year term policy, it's going to take you to age 70. Normally, you have level premiums, meaning you're just going to pay that amount, whatever you decided on. It was, $100 for 500,000 in coverage or whatever it is. You're just going to pay that monthly amount for the 30 years. It's never going to go up if you have a level policy, because some people, check your terms, ladies and gentlemen. Some people have term policies that increase every year or every couple years. So you might want to take a look at that and see if that's your policy. But if not, you have a level term policy. You're just going to pay that same amount all the way for those 30 years. Now, technically, when you get to year 31, what you were paying, let's say you're paying $100, that now is going to jump up 10 to 25 times what you were paying. So now when you're literally right out of that first year of the term, so year 31, if you have a 30-year term, you're going to go from paying $100 a month to paying $1,400 a month or right, something crazy, just for the same amount of coverage. Technically, if you kept paying that, it's going to go up every year. But technically, if you kept paying that term, you'll keep the coverage. It's just it's going to keep going up every year, and it's not going to be $100. It's going to be thousands of dollars a month that you would have to keep paying in order to keep your term policy. So most people don't do that. That's why they cancel their term and they say, okay, I'm done. I'm not going to pay this amount. And I'm either going to be, and this is where we'll get into Uncle Dave, we're either going to be self-insured by that point, or we're going to just go get some burial coverage, something that just like allows us to have some burial, final expense. Did that explain it? Did that explain the?
It did. It did. It did.
Process.
It did. So what else should one know? Is there like too young? Is there like a too young? If you're talking about 30 years and I'm 20, right? Is that like too young?
I don't think there's ever an age to be too young to be protected. We all know people that have passed away at every age, right?
Sure.
Right? Like, at the end of the day, it's just protecting your income, protecting your life, so to speak, right? And what you're about to go off and do. So before the age of 18, any juveniles, people that are under the age of 18, you only have access to permanent life insurance, right? So a child, a 15-year-old cannot get a term policy, right? You have to be protected permanently if you're under the age of 18. And those policies, if set up properly, again, all this stuff are if it's set up properly, if you're putting enough money in, well, that could actually grow for that child so that they might never have to go back and get life insurance ever. And they might have enough that continues their life insurance even when they're an adult, right? So if it's set up right for somebody, they might never have to go back And it could start very young. My daughter got a life insurance policy when she was 6 months old, right? Because it works as cash value, right? She's able to grow money. And again, she may never have to go back and get a life insurance policy ever again for the rest of her life, potentially.
Now, are those level as well? Does one, basically at 6 months, right? You got a whole lot of life ahead of you, right?
Mm-hmm.
So, am I able to lock in a rate for the rest of her life?
Mm-hmm. If you set it up early enough, you can lock in a rate for her entire life. Like literally, I think the illustration shows like if we pay $60 a month, if we chose to do it until she was like 60 years old, she'd have like $1.2 million in there or something inside of her cash value. And in the policy we ever set up in, which is called an IUL, an Index Universal Life, she's going to get both, right? The beneficiary would get both the cash value and the face amount, right? So that policy is just growing over time. And God forbid she were to pass away later down the line, like it's still going to be a life insurance benefit there of $1 million+. So, uh, yes, if you can lock in that rate earlier rather than later, and the nuances of the policy, right? The cost of insurance inside of it may still go up a little bit, but because you've been growing a cash value and what you've put in is still earning interest, those things outpace the amount of cost of insurance that's in there. Again, if structured properly. All of this stuff is if structured properly. I always have to say that because I've been doing this for some time.
Yeah,
And
yeah. So
there's
let's take a couple steps back. You said the what inside of it may go up.
the
Because
cash,
let me explain what I'm asking here
yeah.
for the person who, like myself, who's not as well versed, right?
Sure.
What I'm asking here is, can I out of my pocket pay $60 locked in for as long as I want to stay locked in, and the policy is growing or like whatever is happening? So what I'm most concerned about is when I do my budget, is the items still say $60 towards life insurance, and hopefully all the other stuff, quite frankly, would be bonus for me, or somebody like me, right?
Mm.
Whether it's growing, whether it's doing whatever, as long as I'm able to lock it in, I'm good at 60, and she's 125, right? It's still it's still going out. Now, if that's like, oh, I need more information to actually answer that question, it is. But like I think somebody watching this like me, that's what they're gonna want to know.
Yeah. And it's a good question. You know how you always say like it depends, right? Like
Oh yeah,
maybe,
that's what I'm
right?
saying. Yeah.
The technical answer is it depends, but yes, you could get a policy. You can get a policy that is, it's going to be a permanent life insurance policy. Now, under the heading of permanent life insurance, you have whole life, there's universal life, there's variable universal life, there's indexed universal life. All of these products fall under the heading of permanent life insurance, and all of them work a little bit differently. But you could get a whole life policy if structured properly with the right face amount, depending on what that face amount is, and you can lock in whatever that premium amount is. If it's, we're talking low numbers, right? Because we're talking about kids, but let's just say it's $60, let's say it's $100. You can literally just pay that $100 all the way out, or right, as long as you want to. Typically it's going to be, if it's a whole life policy, you're paying it 20 plus years probably, right? But you can pay that, and that $100 or 60 or whatever number we said, it's not going to go up or go down. That's all you are going to pay every single month for the life insurance. So the answer is yes.
Got you. Got you.
Inside of that policy, this is why it depends, because inside of that policy, what's actually happening is the cost of insurance, how much it costs to insure you in that policy, will incrementally go up every year. That's what's actually happening inside of the policy. So if designed properly, you should already have blown past, like, again, by the time you're 92 or whatever the case is, you should have already either paid for enough insurance that it's paid up insurance. That's what whole life does, right? It pays up your insurance. Or you've grown enough cash value that the cash value inside of that permanent policy is growing so much that whatever is coming out for cost of insurance doesn't even factor in because you're growing so much more interest over top of it. That's the technical nature of these permanent policies. But again, to answer the question, could you just have one premium and just pay that all the way out and have coverage? Yes, you can have a policy like that.
Got you. Got you. So that's a little complicated for me.
It can get. That's why we have these conversations, and we always encourage, right? Meet with somebody to talk about it, to explain how all of these work, because it's all different for every person, right?
Yeah.
It's like this could fit you, but this could fit you. Maybe it's whole life, maybe it's IUL. You just got to
Sure.
understand kind of what you're looking to do and how a product like this could benefit you.
Yeah.
The
Yeah.
easiest thing to know is the term side.
Right.
That's why most people get it, in all honesty. It's because it's simple. It's like car insurance. I have this amount of coverage. This is how much I pay. I do this for X amount of time. Done.
Right.
That's why
Right.
people get it.
Simple.
But in the long run, does that really help? This is what I've seen by doing this, right? By being in business and actually talking to people. And this is, again, no knock on anyone that has term. I have term policy, right? Like at the end of the day, there's a need for it. But what we have to understand is we have to understand how it works. How it works is you are covered for a window of time. Typically it's going to be 20 or 30 years or something, 20, 25, 30 years, something like that. After that time, if you have not done what you needed to do in life financially, you will now be a burden to your family. That's just the way it goes, right? Talk Dave Ramsey a bit. It supposes that getting term insurance will allow you to buy term, invest the difference of what you would have put inside of a permanent life insurance policy, invest it somewhere else, and then make sure that you become self-insured by the time you would outlive that term, 60, 65, 70, so that you will then have enough money to be able to give, pass down, do as you please, pay for burial, replace your income, pay off debts, all that stuff. That is not happening in our society as much as people would like to say.
Got you.
The 65 and older community across the board are not as self-insured to make sure the next generations are okay than they would like to be, right? Like that's where we're at. So the strategy, if it works, it'll work. If you get term just for 20, 30 years, and then you do everything you can to make sure you have enough money to take care of debts, income, taxes, grandkids, whatever it is that you were planning on doing anyway, then that's the strategy. But if that's not it, then we're really leaving people like kind of stranded without anything if all we did was go term. See, like it's aspirational for us to say, just get term and then be good. But that doesn't fit everybody because there's a group of people, our community specific, that might not be self-insured. Considering the average, the median 401k for people between 50 and 59 has $253,000 in it. So, and that's going to all be taxed at their tax rate. So if then they go, now we're going into that part of their life with no insurance coverage either, and we don't have a big retirement, like, then what financially are we passing down? We just giving them a house that's going to get taxed? Right? Like what is the plan of generational? That's why there's a need for the permanent side of life insurance to say, you know what? I care that even if I go at age 80, I'm going to make sure my child has $100,000, $250,000, $500,000, no matter what. Not just if I pass away in this window of time. And if I don't pass away in this window of time, it's kind of on me to figure this thing out.
Right. Right. Got it. Got it. Got it. Got it. So again, like you say, it depends.
That's
All
right.
right. It depends. And now let me backtrack and ask you this question. Why do you think that the 65 and up community, as you said, well, one, how many, I guess, if you know the information, how many of them are not self-insured by that age where insurance runs out?
A
Like,
lot.
are we talking about 50%, 60%? Like, what are we talking about? And
I will try to get you some stats on it, but
okay,
I would,
and before you answer that,
yeah,
why?
yeah,
Why? What's happening?
yeah.
Are they
So
negligent? Are they what's going on? Do they not know how? Does life throw them something? Like
mhm.
what is going on?
These are great questions. It's a combination of all those things. I got to get you the stats on it, but I would venture, and I'm not coming off of any basis, but I would venture that it's actually probably more than like 75% of of baby boomers, or like the over 60 in this country are not self-insured. So 25,
75%?
yeah, absolutely.
Wow.
We're like, bro, people don't really understand. We're in a real retirement crisis. Like, we're in a real, like, people, we hang out in our pockets, so we only kind of see what we're around a little bit. And on top of it, that generation,
Sure.
they are so scared to talk about money because
Yeah.
that's not how they grew up. So they're not even talking about the numbers for anyone to get a real insight. But I get that. I really work with 50 to 55 and older community and lift up the hood under their financial life, because they've been working at a job forever. They've never really sat down with financial professionals. They have people that kind of help them here and there. They thought they knew. Now they're at the end of the road and they're scared. I work with a lot of them, a lot more than people think. Right. And so that number is a lot higher. Like or I'll say it the other way, the number of people that are self-insured that are over the age of 60 or 65 is a lot less than people think. A lot less. A lot less. Like, I'm being generous when I'm saying 25%. Like, I think it might be closer to the 15% or 10% of people over that age are actually self-insured. Right? Like, it's not the greatest. It's
Yeah.
not.
So
It's
what's happening? What's happening?
uh lack of, so what are the stuff we talk about? I talk about all the time. Lack of financial education. There's a What you hear me talk about all the time is there's a select group of people in our country that get the majority of the financial help. Typically the top 15% of Americans get the majority of financial help from the biggest companies, the biggest banks: Charles Schwab, Merrill Lynch, Morgan Stanley, Edward Jones, Vanguard, Fidelity. They are going after the top 15%. Right? Everybody else just has a very baseline understanding of money. Spend less than I make, try to stay out of consumer debt, try to save, invest money for the long haul. But where do you save and invest money? I don't know. I got to put it in this 401k or IRA. That's what they told me. Lack of financial education. Lack of financial education. Right? They don't know. Secondly, what I always say is lack of financial foundation. Lack of financial foundation. Life happens. You've played Cash Flow 101, right?
Oh
You've
yeah.
played it. So the good
Do
old
that.
doodad, right? The doodad. For people that struggle in life, it's because they have a lot of doodads and they don't know that that's a part of life. So they don't plan for it. They just literally think that it's them that keeps running into these doodads. No, that's life. We don't have a foundation of how to plan for the doodads. We don't have a foundation of how to make sure we have adequate savings and not go into too much right high interest debt. We gamble a little bit with the money as we get older. There's a lot of psychological things that start coming in when you hit your late 30s, mid 40s, and you don't think you're where you want to be or where you should be at that time. So what do? You take some risks. You gamble a little bit. You start that side business. You
Go to
cash out.
Vegas.
You go to Vegas and try to do it, right? You try to figure something out. And normally that play doesn't work out the way that you wanted to. And it kind of keeps you where you are. So you just work more hours and you keep doing the same stuff. it's there's a lack of like financial education of what to do. There's a lack of financial foundation in people's finances, so they don't know how to actually build on it. Most people's money is cyclical with the market. Oh, the market's doing good, I'm making money. Oh, the market's not good, I don't have money. Oh, the market's good again. Oh, the market's not good. And every 5, 6, 7, 8 years, this is their life, right? They're doing great and then they're not doing great. They're doing great and they're not doing great. But wealthy people learn how to build on those downtimes so the market does not determine their own personal success. They have a foundation. I heard Tillman Fertitta, that's his name, Houston Rockets dude. He was like, the secret to him building wealth was he never had to sell any of his assets. He was like, all the down markets, everything that came, it didn't matter. I just didn't have to sell anything. The average American can't say that. It'll happen again in this recession. When the market goes down, somebody's going to sell their house because they don't have the cash. They don't have the money. They don't have the foundation. They're going to sell that investment property if times get too hard and somebody stops paying rent for 3 months. Like, that's just what's going to happen. They're not in a financial position to keep holding on to the assets to really be self-insured and do all the things they want to do. Every time the market goes, their finances go. They take a hit. They go back to kind of level 1. Then they build up to level 6. And then they get knocked back down to level 1. Doodads. That's really what happens. People always have the intention of building wealth. I talk to a lot of younger people about this.
Yeah.
Right? You'll get younger people in their 20s that are like, I'm trying to be retired when I'm 25 and have $80 million. And I'm like, great. Like, I'm glad you have big goals and dreams. Here's the question. Why don't people get there? Do you think it's from a lack of them wanting to?
No.
You think right? Like, everybody wants to.
Yeah.
So we really have to figure out why. And it's financial education, financial foundation, not getting good guidance around money, and then just kind of rolling with the punches.
And man, I think this is a great episode. We started insurance, but we're also digging to the deeper roots as to what makes it so important. And something we talk about quite often and want to highlight and connect this to this is this concept of doodads. Now, there's doodads. There's two types of doodads, and to make a contribution here, two types of doodads. There's those that are unpredictable and those that are very predictable. When we look at life, some of the biggest doodads in life are very predictable, right? College, car, place to live, whether it's mortgage or rent, weddings. So these things are very predictable, but in my experience, for some reason, they still sneak up on us. Right? For some reason, they still sneak up on us. We're unprepared. We overspend, and they kind of anchor us deeper into where we are. And unless you have been blessed enough to have, generational wealth to kind of help you get over those bumps, or you're disciplined and financially educated enough to swerve around those things, in my experience, those are the things that are most responsible for keeping people from getting to those big goals and keeping us kind of where we are, stuck in this, so that we're wishing, praying, and hoping for an athlete in the family, for a lottery winner in the family, for X in the family, rather than methodically building wealth. So that's what I was thinking about when you said that.
It's so true. And right, the United States is going to be in for a rude awakening potentially, right? Again, we don't want to talk all the doom and gloom, but this is the good life, right? We want you to get to the life that you want. And you got to know, like, our country right now, not doing well financially, right? And so I heard Ray Dalio say this, that like, the country is like the sum of its parts or whatever, like the sum of the people. So like if we have a spending problem in the country, like from a country level, from an economy level, like we have spending problem individually as well.
Absolutely.
And we're going to get humbled very quickly because people are going to have to learn how to be frugal again and learn how to just pay and use money for the things that are necessities. And I think we have a long, like, kind of coming down this list, this road of what we think are necessities, but really are just luxuries. And to tie that all in, life insurance will eventually be back to a necessity where people realize, like, yo, this is really going to save my family potentially, right? If things get really bad, like, and we pass away and I leave, I'm the breadwinner. Like, see, we think of this out of a place of like opulence and where we are here in our society. But like, imagine if you were on the other side of a depression and we're coming out of 20 years of a depression and economy's not where it is and you're just scraping by, and you have a life insurance policy that pays out your family if you weren't here, that would literally give them a better life. It
Right,
would right, it would
right,
literally save
right,
them from like potentially not being hungry for
right.
a couple generations, potentially, depending on how much you leave behind or whatever. We don't look at it that way because we're like, it's we'll get $20,000 or we'll get $100,000. What's that going to do? Like, yeah, nothing now, maybe if you think of it that way, but like in the future, that might really be something that saves your family. And life insurance is one of those things. Like, you can't get it when it's too late. Like once you're gone, you can't go back and get it. So
Can't
you
do
got to
it.
make sure you have it.
Man, listen, I think there's a lot to chew on this episode right here. I'll ask the question, if somebody listens to this, they're saying, okay, didn't know that. I am clearly not protected. I'm not in the right spot. I'm not taking care of my family, whether it's just me and my spouse, or me, my spouse, and some little ones running around, or just maybe me, my parents, right, are not taken care of. What is the first step? What should they do? Is the first step reaching out to you? Like, how should they handle the situation? Give them something they can take away, something they can take home and feel good about. Dang it!
Well, first off, you all know where to find me, right? So, yes, I always recommend reach out, have a conversation. I can't speak for other people in the industry or people that have this knowledge, but like I'm always open to having a conversation, even if you just had a question. Hey, this is what I saw on my insurance. Hey, what's this about? Or hey, this is something I saw on the TV. Like, what's this about? I'm more than happy to answer that question. So get reputable, right? Just good information that's going to help you down the process. Secondly, though, it's life insurance awareness month, right? So become more aware of your policy. First and foremost, if you have life insurance, four things you should know: the name of the company, how much you pay every month, what type of policy it is, and how much coverage you have. So if you already have life insurance, you should be able to rattle those things off: the name of the company that you're with, the type of policy that you have. Is it term? Is it permanent? How many years? Is it whole life? Is it IUL? 20 years, whatever, right? How much coverage do you have? So I have 100,000, I have 20,000, I have 400,000, I got a million, got 2 million. And how much do you pay a month or how much do you pay annually for that? That's the information you first need to know to become more aware of your policy. If you don't know how to answer those questions and you have life insurance, again, reach out, get some information either from your agent currently or reach out to someone like myself to help you find all that information and we can read it to you. But you got to become aware of the life insurance that you currently have. Do Your job insurance does not count, ladies and gentlemen, just so you know. Like, if you have job
Mm,
insurance, that's great. It's like kind of icing on the cake or a cherry on top. But normally that policy, one, is not going to you're not going to be able to carry that policy with you, and two, normally it's not as much coverage as you actually need. So
mm,
don't even worry about the job insurance. In all honesty, let that just be extra. Personal life insurance, though, you got to get to the bottom of it. And then if you don't have a policy, then we need to sit down and have conversations to get educated about what the right types are for you, whether it's term, whether it's permanent, how much coverage you need, and what fits the budget to make sure you're putting it away properly. So yeah, there were a couple things there for somebody.
oh yeah. Oh yeah. Oh yeah. Listen, brother. I know we've started this conversation before. I got to make a call. I feel called out. I'm not doing the things the right way. So we'll definitely be having a conversation. And guys, you heard Chris. I will highly recommend that you, and I can recommend because I'm not held by any agencies here. Gosh darn it. I will highly recommend that you have a conversation with the man. He's very accessible. Very, very passionate about this work. You know, loves the people in the top 15%, but also loves the people in the bottom, whatever it is. Like, what is it, 85%?
85. I love the bottom.
85%.
I
Math is not I'm not an actuary.
clearly, but
Yeah,
I
yeah.
love them all. The 85, I know we don't get as much love, but the 15% I still love on y'all too. But the
Uh,
85 just needs a little bit more love. We just need a little
Yeah,
bit more.
he's here. He's here for the 85. Call him Mr. 85. You know, he's here for us. So appreciate you, brother. I'm bringing all this knowledge today. I think this is a great place to leave a conversation for people to really go and rewatch this one. Right, go back, rewatch this one. You're gonna learn more the second time around, maybe even the fourth time around. And make sure you email, text, message, send an owl, send a telegram, contact him at, what's the handle? Is it
It's at see Mouzon one.
at C Mouzon one? And seriously, guys, make sure you have the conversation. The man's giving his time. It's not free. It cost him something, but he's making sure he's sitting down and having a conversation with you. So I would highly encourage you to take advantage of this. And like we said, there's no time like the present. And when it's too late, it's too late. So we appreciate you guys for being with us here today on a very important topic, something that I feel is true. Again, I'm going to go ahead. I got to have some conversations with you, brother. So we're talking here.
We'll talk.
But with that said, go ahead and make sure you share this episode. There's no if on this one. There's definitely somebody in your life that needs to hear this conversation today. All right. Make sure you share it with that. It might be a parent, it might be a spouse. Maybe this is the way you get the conversation started. You guys put some popcorn on, you sit down and you say, hey, baby, let's watch this episode right here. And then Mr. Mouzon lays it on. And then she's like, oh, do we have our stuff straight? Like, no, I'm glad you asked. And then you give the brother a call and you come in together and you have the conversation, because he works great with couples as well. I've seen it myself, guys. So appreciate you. Go ahead and like this one, share with somebody. And until next time, peace.
Peace, guys. Appreciate it.